Okay, I think we're up. Good evening, ladies and gentlemen. Welcome to the show. You are watching 58home.ca. It is Wednesday, March the 9th, and we are streaming live in Toronto, Ontario. Today, we are pleased to have our two special guests, Christine Xu, President of MoneyBroker of Canada, one of the most famous mortgage specialists in Chinese community and across GTA, co-starring with Michael Carringer, specialized in mortgage investments, the Vice President of Firm Capital for almost 20 years. Guys, please say hi to everyone.
Hi, Simon. Thank you very much, Simon. I'm very happy to come back again to 58home.ca. I'm very happy to come together with my friend and business partner, Michael Carriger from Firm Capital. So today, the seminar going to be 3 parts. I'm going to start with a brief introduction of myself and our business, and later on, Mike will take over the stage, introduce Firm Capital and why Firm Capital is one of the most important non-bank lender in the commercial space. And later on is Q&A. So if anyone has any questions, before you forget your question, you can write it down on the chat room, chat box. And after Michael's presentation, we will answer all the questions. Okay, let's start. So I'm going to share my screen just so I can easily time myself, and we're going to do a brief introduction. Oh, perfect. Can anyone see my screen? Michael, can you see my screen?
Yes, I can see your screen.
Perfect. So my name is Christine Xu. We have 2 companies. One is MoneyBroker Canada. One is Ready Capital Mortgage Investment Trust. Those are 2 companies I work with. Those 2 companies are complementary to each other. One is a mortgage brokerage, as MoneyBroker Canada, and the other one, Ready Capital Mortgage Investment Trust, are private mortgage lenders. We invest exclusively in private mortgages. A little bit about myself. I came to Canada a while ago, 1989, and as an international student, came with me. I bring $200 with me. That's my humble start in Canada. I work in the bank and study in U of T. So I got my economics degrees, and I became the first Mandarin-speaking financial advisor in Toronto in 1993, working as an investment advisor for Investors Group. Later on, in 2000, I became the first Mandarin-speaking mortgage broker in Toronto, in GTA. So from 2000 until now, 22 years. So over past 22 years, I'm doing only one thing and one thing only as a mortgage broker. So of course, I can call myself a specialist and expert in the field. And so I've been receiving lots of awards and recognitions in the industry. I'm very proud and honored to be a 3 times award recipient as the Alternative Mortgage Broker Specialist of the Year in Canada in 2015, 18, and 2020. Last year, I was selected as the Global 100 for the mortgage specialists globally. I'm very honored, very proud to be part of that team as well. Every year, almost, I was one of the women of influence in the mortgage industry, especially in 2013, which I want to point out, I was one of the top 10 commercial brokers by CMP magazine choosing. So in 2013, start doing quite a bit in commercial mortgage side. I was top 75 mortgage brokers almost every year. And I'm especially proud to be the Diamond Jubilee Award recipient in 2012 for my community contribution. So about MoneyBroker Canada, we are a boutique mortgage brokerage specialized in alternative financing. So what is alternative financing? We see the whole financing space, we roughly divided into three parts. One is called Schedule A lenders. Schedule A lenders is usually, we call all those big five banks or some other banks. We qualify the borrower because they are with the good income, with the good credit. Residential side, commercial side, the same thing. And Schedule B lenders usually are those trust companies. The most famous one in Canada are Equitable Bank, Home Trust Bank of Canada, and some other trust companies and credit unions we call Schedule B lenders. So Schedule B lenders usually are more generous in terms of using income to qualify their borrowers, more generous in terms of giving credits for people who has not a perfect credit score. So we call B lenders, and then the last part, the non-bank and private lenders, usually we're called alternative lenders. We are specialized, as MoneyBroker, we are specialized in alternative financing. In past few years, our business, majority of our business, more than 80% of business are alternative financing business. So people comes to us because they cannot get their financing needs fulfilled by the regular banks. So on the residential side and commercial side as well. So we are helping the borrower to get the financing they need for their residential home, for the commercial properties from alternative source. So Fern Capital is one of the large non-bank lenders in the mainly commercial side, also in some residential side as well. So later on, Michael will introduce Fern Capital as well. So Fern Capital is one of our lenders we work together with, not only as a lenders, we also work together with lots of private lenders as business partners. The reason we can be business partners because we have another side of business. It's Ready Capital Mortgage Investment Trust. So Ready Capital Mortgage Investment Trust is a mutual fund trust, invest exclusively in mortgages. We do residential mortgage and we do commercial mortgages as well. So currently, the Ready Capital Mortgage Investment Trust, we have 3 years history. We have over 400 investors. Right now, we have 45 million under administration, which lending in Ontario, mainly actually right now 100% of investment are in Ontario. We do work together with many lending partners in Ontario and BC in residential space and also in commercial space. So Fern Capital is one of our very good working partners. A little bit about Ready Capital. So Ready Capital is a mortgage investment trust. It's a mutual fund trust. We invest, again, 100% of our investments are in mortgages. So it's very secure. We don't invest anything. We don't hold real estate directly. We only invest in debts. We only invest in mortgages. And our projected returns is 8% annually for all our investors. And we give fixed monthly distributions based on 8% returns. So the investor will receive their interest monthly based on 8% returns. And there's no lock-in period. So anytime investor needs money for other investment, they give us 2 months notice, can withdraw their money. And since it is a mutual fund trust, we can take money as in the personal account, at the corporate account, and we can take RSP and TFSA investment as well. So that's it. That's all the introduction about MoneyBroker Canada and Ready Capital. And I'm going to stop sharing my screens. So I will let Michael Carriger to introduce himself and Firm Capital. So there's Michael going to give us lots of examples of what he did, what Firm Capital have done, and then we'll invite questions from all the audience. So I'm going to help Michael to see his presentation. Just give me 1 second. Sorry, share screen. Here we go.
Right. Okay, Christine, thank you very much. And thank you for inviting me to participate on your panel this evening. I'm very excited to do so. And good evening to everybody out there. My name is Michael Carriger, and I'm Vice President of Mortgage Investments at Firm Capital Corporation. I joined Firm Capital in 2004, so about 18 years ago, and I've been involved in real estate finance for the last over 30 years. I'm part of the senior management team, but my key responsibilities on a day-to-day basis are to originate and structure real estate transactions in various urban markets across Canada. I'm also very fortunate to say that I feel fortunate from the perspective I get to work with a very talented group of people at Firm Capital. So what I would like to do now is to speak to you about 10 sample real estate transactions that were completed by Firm Capital in 2021. So why don't we just start off, and we'll start with a small deal. So on the top left-hand corner of the screen, you'll see a $2,485,000 transaction. So this is a land acquisition facility for a future residential development site located just outside of Ottawa. In this case, the borrower is a very experienced land developer in the Ottawa marketplace. This deal was very time sensitive, as we only had 3 weeks from the day the commitment letter was signed to actual closing. The loan to value, loan to purchase price in this situation was about 65%. The term of the loan was 24 months, interest only and fully open. Our repayment on this transaction is expected to come from a bank once land use approvals are achieved. So some might say 3 weeks is a lot of time to actually close a mortgage transaction, but when you're involved in land financing, though, it's more complicated. So why is it more complicated? Because what you need to do, if they're future residential development lands, you have to understand where those lands stand from a planning perspective today. So we receive planning letters, we review geotechnical soils reports, environmental reports, and development pro formas are prepared by the developer, so we can make intelligent decisions in terms of whether it's a loan that makes sense for Firm Capital. The second transaction I'd like to talk to you about is an inventory loan. So we're going to switch gears and we're going to move to Montreal. So this particular project is a condominium building in downtown Montreal. So what we did here is that we financed 23 residential condominium units and 1 commercial unit. In this situation, all the units were leased, and the developer was looking to refinance existing debt and also get an equity takeout, which we were happy to provide. So this, our loan to value here is about 65%. It's a bridge loan. So again, it's interest only, fully open, and 12 months. So those 12 months have come by, and this developer came back and said, would you provide us with a 12-month renewal? And we said, we'd be happy to do so. This particular borrower made all their interest payments. And so I think that one of the things that as a, for you developers, real estate owners are in the audience, is very important for you to understand who you're doing business with. There have been a lot of new entry capital participants over the last 5 years, but it's very, very important to know who you're doing business with. And the reason for that is because developments take much longer from time to time and things happen. So to understand who you're doing business with and who makes decisions is important when you're actually we're looking for a loan renewal or possibly a loan amendment. So the third transaction I'd like to talk to you about is a secondary debt bridge loan on multi-residential properties located in Alberta and Saskatchewan. So here we have our secondary debt, which is subject to institutional first mortgages. We have a borrower who is a very significant private REIT that's located in Western Canada. The purpose of this loan facility was really to create capital, or you could call it an equity takeout, so they could pursue further acquisitions in the marketplace and grow their business. Our loan to value in this situation was about 75 to 80%. The term of the loan was 24 months, interest only, and fully open again. Our repayment will come from the refinancing of the various existing first mortgages that are in the portfolio. So we'll have to provide a partial discharge provision to the developers so that when they do refinance properties 1, 2, and 3, what type of amount of money we're looking to get back at that point in time. So now what I'd like to do is I'd like to talk to you about infill construction financing. So you'll see deal number 4, if you will. It's a $4,150,000 second mortgage construction loan. So the first mortgage here is held by a bank. How did the bank get involved? So what happens in infill construction financing is that when someone buys a property, there's typically a house on it. So what they'll do is they'll go to a bank and get the cheapest financing that they can get, and then take the property through the approvals process. And once they know what they can build and they're ready for construction financing, they'll come and talk to people like Firm Capital. So we do a second mortgage construction loan. And what does that mean? So what that means is we provide 100% of the hard construction costs as well as an interest reserve. The loan to value in this situation was about 65%. The term of the loan here was 18 months, and it's interest only again and fully open. So where does our repayment come from? So the repayment here would come from, could be one of 2 sources. At the end of the project, the builder may just refinance us through an institutional lender, or it could be a sale of the property. So there are really 2 exit strategies from our perspective. So we're going to move to another housing situation, and there's a $2,000,001 transaction, which is on your screen in the top right-hand corner. So here we have a builder that we provided construction financing for. So he finished the house, and then he came back and said, okay, house is finished. I think I might live in it for another 6 or 12 months. I want to refinance the existing construction loan, and I want to take some equity out of this property. So can you give me a 12-month term, interest only? And we said, sure, that sounds fine. So our loan to value here is about 70%. And again, our repayment will come from a refinance by an institutional lender or a sale of a property. So next, we're going to move into construction. So in the bottom left-hand corner, you'll see a construction loan for $5,600,000. So this is a construction loan for a 14-unit, 65-bedroom student resident building in Waterloo, Ontario. In this case, we have an inexperienced borrower. We deal with small developers, mid-sized developers, and large developers. Here, we have an inexperienced borrower, and we work with a lot of experienced builders, and we're happy to do that because of our experience levels and our track record. So in this situation, though, the question would be, so he acquired an attractive piece of property for development for this build out, but he doesn't have any construction expertise. So how we mitigate that risk is that we ensured that he took on board a very experienced construction manager to actually build this out for him. In situations when you have construction financing, what we do is we fund on a work in place, cost to complete basis, and there's a cost consultant in place to monitor that. The loan to cost here was about 75%, which means there's about 25% equity in the part of the builder, the future investment property owner. And a repayment will materialize when the property is leased and stabilized. We'll get institutional financing at that point in time. So that's one of the things that we do when we do transactions, because we do a lot of bridge financing. Exit strategy, and for us to understand exit strategy is very, very important. Deal number 7, it's deal number 6, I apologize. So this is a $7,450,000 first mortgage land and servicing loan. So we initially got involved in this land parcel when it was acquired and before they actually received a draft plan approval. So once they received draft plan approval, they came back and said, would you refinance this existing land loan? But not only refinance the existing land loan, we want to buy out a couple of our partners. And we said, okay, we'll do an analysis and see if that makes sense for us. Plus, we've also provided funding for the servicing loan. So the site right now is underway from a servicing perspective. And we think what will happen in this particular file is that the builder/developer will come back to us and say, oh, we now have service lots. We're going to sell some homes and we'd like some construction financing. So for us to provide construction financing for all 13 houses, we would probably want maybe 6 or 7 of those homes sold. Well, what determines that number is something called a residual analysis that we do. And that really just tells us what our exposure is going to be on the remaining houses. Okay, so next I'm going to talk to you about an acquisition of a 126-unit apartment building in Sault Ste. Marie. So the purchase price here was plus or minus $12 million. We gave this investment property owner $9 million, so about a 75% loan to purchase price. Now, the borrower's down payment didn't come from cash equity. What happened in this situation, it's interesting, he has a portfolio of real estate properties. What he ended up doing was he ended up refinancing these properties to come up with his $3 million plus his closing costs. And the lender that provided said, okay, I'm going to give you monies on your existing portfolio, but at the same point in time, I want to register a second charge behind firm capital, not a $9 million mortgage. And he would have to get our approval to do so. We're fine with that when it comes to second mortgages. We typically don't get a subordination agreement from the second mortgage lender unless it's a construction loan or a development loan. So in this situation, the building was actually poorly managed, and the new owner wants to do some CapEx and new leasing. So once that's completed, his plan is to approach CMHC for a new loan. And in order to do this, he will also have to refinance the existing second mortgage that's on this property, because you can't be showing second mortgages on a property when you go to CMHC for financing. Deal number 9, if you will, is a land loan. So we do small loans, we do mid-sized loans, and we also do larger loans as well. So this is a $38 million financing. These are lands. This is a multi-phase mixed-use development located in the Niagara Falls marketplace, just south of Toronto. So here, our capital was used refinancing more expensive private debt, as well as to provide capital to allow the developer to push forward with the development of the project. So phase 1 actually has approvals in place, and there is some commercial real estate, but the primary focus in the first phase is going to be the low-rise housing. So we're talking about singles and towns, and the plan is for them to open up for pre-sales on or about this summer. So what's our exit strategy for a $38 million land loan? So assuming that they can be successful and get the level of pre-sales to satisfy an institutional lender to repay the existing bridge financing, and then to provide the capital for the servicing, postal letters of credit, and also the construction financing, then that would be our exit. And lastly, deal number 10 is another construction loan for, 129 unit apartment building located in Welland, Ontario. In this case, we have an experienced borrower who's actually putting down 20% equity. So the loan to cost is 80% in this case. And the loan to value on a pro forma basis is about 70% loan to value. Our repayment will materialize once the property is yet again leased as well as stabilized. So those are some of the select transactions I want to share with you. And what I'd like to do now, Christine, is just continue with the next part of my presentation. So Firm Capital Corporation has been in operation and in the same industry for 35 years. So Firm Capital Corporation is actually the mortgage banker for a public MIC, Firm Capital Mortgage Investment Corporation, which trades in the Toronto Stock Exchange and has been in business since 1999, has a very solid track record. So this is one, so Firm Capital MIC is one of our investors, plus we have other investors. We are direct non-bank lenders with proprietary capital. Why do I say proprietary capital? Is because we do have a public MIC that has capital available and our other investors at any point in time. Our mortgage assets under management from a debt, so we have debt mortgage investments of plus or minus 1.4 billion. And our loan amounts range anywhere from $1 million to $50 million plus. And we've done bigger transactions than that. Our client base would be builders, developers, and investment property owners, small, mid-size, and larger. And we're focused on major geographical markets across Canada with an emphasis on Toronto, Ottawa, Southwestern Ontario, Montreal, Alberta, and also British Columbia. Our philosophy at Firm Capital is to understand the transaction quickly and to structure it quickly so we can meet the borrower's timelines. And as well, we have the ability, since we have proprietary capital, to issue commitment letters within 24 to 48 hours. So next, I'm going to talk to you about some of the financing options. So we did talk about construction financing, just a quick recap. So we do construction financing on low-rise subdivisions. We do infill construction financing as well. And we also provide financing for condominium projects, whether they be mid-rise or high-rise projects. When it comes to bridge financing, whether it be acquisition or stabilization loans, what's an example of a stabilization loan? It could be a multi-residential apartment building that you own that maybe needs some retrofits or repairs that you want to take on. So we provide funding for that. When it comes to land financing, we finance future development lands, building lots, and also we provide servicing on lands as well. Typically, our land financing in terms of loan to values, we want to be in the, say, the 50 to 60% range. On exceptions, if we have really good covenants and great track records, then we can be a little bit more aggressive than that. We also have an alternative residential mortgage lending program, which focuses on houses, condos, and cottage loans. So this program are for owners and investors. It could be for a purchase or a refinance or an equity takeout. And what we do is that since we're a non-bank lender, we're not competing on price, obviously, but so it has to be on service, but also we focus on the equity value that's in the real estate. What do I mean by that is, so we look very hard at the appraisals to make sure we understand the market comparables, and we make sure that we understand the value of that property, because we put a lot of emphasis on the real estate value side of the equation. Next, on terms of infill construction financing, I actually shared with you just earlier a second mortgage construction loan. And from time to time, we do first mortgage construction loans, and we like to do those as well. So the construction financing program is quite simple. If we're doing a first mortgage construction loan, we provide a land advance facility, a hard cost construction loan facility, as well as an interest reserve facility. And that typically works out to the loan to cost typically is no greater than 80%, and loan to value is typically no higher than 70%. So when we are doing our underwriting, we engage an experienced appraiser to give us an as-is land value and a completed value for the house based on the plans the builder intends to move forward with. And lastly, secondary debt on investment properties. I did share with you that bigger transaction where we're doing secondary debt on investment properties. And that's really to help investment property owners actually takes, it could be an acquisition that they have coming up where they want to raise some fast capital. And it's used, the terms of these loans are anywhere from 12 to 18 months. So the question is, what don't we finance? So what we don't finance hotels, motels, golf courses, or banquet halls. But in real estate, from a financing perspective, Firm Capital's worked closely with Christine. And if you have any inquiries in respect to, of course, anything we're talking about here today, but if it happens to be business-related real estate, you can reach out and talk to her and her team. So next, we're going to just talk a little bit about our track record in doing transactions. So you can see that in 2021, it actually was a record year for Firm Capital. We did about $1.05 billion in transactions. And you can see 2020, we only did $560 million in transactions. That was the year that we all want to forget, the year of real COVID. And then you can see in the other years, we've been consistently in the 750, 800 million, 900 million, $1 billion range. So, but the other thing about Firm Capital is that we're not in the business for growth for the sake of growth. We're in the business to protect capital as well. So in terms of mortgage lending, I did talk to you about construction and development lending. I did talk to you about investment property financing. And I did touch on the alternative residential lending program. So I'm not sure I have to spend any more time on that. And here, excuse me, this is where I took the 10 sample transactions from to review with you. So I don't think there's any need to get any further into any more sample transactions. And I've taken up enough time, Christine, at this point in time in the presentation to turn it back over to you. Thank you very much.
It's basically cover everything from condominium building for land financing for construction, like in different provinces in Quebec, in Alberta, and like lots of projects close to us in GTA. Actually, I recognize a few transactions. During your presentation, I have a friends text me to say, hey, there's a few transactions. I know who are the owners. So it's really close to home. And then that's very interesting, the examples. So now that's the floor is open, and we'll see if there's any questions. Yeah, a few questions here already. Okay, I'm not sure this is a good question for Michael, but if you want to answer it, it's what's the differences with syndicated mortgage? Like,
what are the differences with a syndicated mortgage?
Yeah. So are you a syndicated mortgage firm?
No, what happens with us is that we are the lender of record for Firm Capital is Firm Capital Mortgage Funding. We don't have our various investors are not involved in taking mortgage security. No. Yeah.
So Firm Capital is lending its own balance book.
Balance sheet, correct.
Balance sheet, yeah. And like sometimes, like we work together with Firm Capital, we do a mortgage together with them, but we don't syndicate. It's a first and second mortgage.
Right.
There's another question. Oops, just missed it. I'm going to just read the question and see whether we would like to answer. For inexperienced borrower for a small MF acquisition, what borrower can do to get a loan approved for small multi-family acquisition, MF, I guess. For inexperienced borrower for a small multi-family acquisition deal, what borrower can do to get loan approved?
Mm-hmm. Well, I think that, so this is a situation where there's going to be, you're contemplating a new acquisition, I believe,
Right.
of a small multifamily property. So I think that what you need to do is, it's in today's marketplace in terms of acquiring multifamily properties, it's very, very competitive. So I think what you want to do is you want to have a good sense in terms of that you are paying market prices, so that when you actually go to arrange financing, you find out and you get that appraisal done that you've overpaid. So if you're looking for conventional financing, there's lots of capital, cheap capital available in the marketplace for multifamily financing. So if you do that acquisition and you're putting down minimum of 25, possibly 30% financing, you can go the CMHC route. But if you're looking for conventional financing, there's lots of interested lenders out there in the marketplace on the institutional side. And also you have credit union options as well. There are other banks that aren't Schedule A banks that would be happy to look at that with you to get conventional financing rates.
Yeah, I want to touch up a little bit on that. So I did a residential mortgage seminar a few weeks ago. I mentioned that the multifamily investment, multifamily properties are one of the best assets because there are multiple incomes. And CMHC has a program with 15% down payment. I think the CMHC improved the program recently with 5% down payment. But we have to warn the borrower that like either 5% down payment or 15% down payment is not your purchase price. It's the appraised value, market value, which is sometimes quite different than your purchase price. So if you only have 15% down payment, lots of times you'll be very in a shock that the property you purchased, probably in a very good price, may not be came in with the same value. So you have to put more money. For lenders like foreign capital, they will require more than 15%, like at least like 25%, right? And then the property may not, like you probably have not very good income because of the previous management is not good enough to get a high enough market rent, or there's some properties they may not have a very good condition. So the loan from foreign capital or other alternative lender can help you to purchase a property and then improve the property later on, getting an institution financing from it.
Right, and I touched on that. That's what we refer to as a stabilization loan. So if this lady was talking, the lady that I did ask that question actually is purchasing a property that's fully tenanted, then we understand that borrowers have to be very responsible. It's their capital, and they're going to try to get the cheapest capital they can, which makes sense.
Okay. So there's another question that asks, is 8% interest income guaranteed? I guess that's the question is directed to me regarding the Ready Capital Mortgage Investment Trust. We cannot guarantee the interest because we are mutual fund trust. It's a security investment. So like anybody for security investment, they say guarantee is incorrect, but we are very confident that that's our projected return. So because we're very confident with the projected return of 8%, we give interest rate monthly, fixed interest rate monthly based on the 8% projected income. The reason we can do that because any investment which generate less than that, we don't lend it out because we only choose the best project. And there's a lot of other lending partners out there we work together with. They have a cheaper capital. So sometimes a good borrower which deserve a better interest rate, we refer out to other working partners. Okay, there's a question, say, is Niagara, because there's a Niagara Falls example you have with your 10 examples. I guess that's a question towards you, that is that Niagara project mortgage is a long-term land loan?
No, the way it's actually structured as a 12-month term loan. So as I mentioned in my comments, and I can just reiterate them, is that what we're expecting to see happen is that when phase one opens up, the developers expecting and their building partner are expecting to be able to sell out all this product, generate the pre-sales that they need to satisfy an institutional lender, which will create an exit strategy for us. But if they came back and they ran into some delays and just in terms of the finalizing their development plan application before they could start servicing, we can actually look at renewals and have an open mind with respect to renewals if there are delays in terms of on the execution side.
Okay, is there any service charge for investment loan? I'm not sure that's for the investment side. If you invest money in ready capital, there's no service charge, where it's completely all the investment, all the returns as a mutual fund trust will give it to investors 100%. If you ask for mortgages, yes, all mortgages have a lender fee and broker fees usually. Mm. Okay, another question: purchased the property 12 million. Mm-hmm. And NOL is 480K per year. How you will base on loan to value over income, I guess?
Okay, I will speak to that just briefly. So I did see that message pop up. So if the net operating income on the property, and I'm not sure what type of property it is, I don't know if it's office, I don't know if it's retail or what it might be, but if it's a property that deserves a 5% cap rate, $480,000 of income, 480 divided by 0.05, that's 9.6 million. So that's what your value would be. And if you're saying that you purchased something for 12 million, then you ended up paying, you paid a very, very low cap rate. So I'm not sure what, so that's 1 second. That's like a 4% cap rate. Maybe it's a multifamily property. I'm not sure, but there would have to be some clarity provided with respect to that.
Yeah, that's also I want to jump in to say, like, lots of people are calling us to see, like, I bought a commercial property. What's your interest rate? I said I can't answer that because there's so many different types of commercial properties. Depends what kind of properties, where the location is, what's the use of the property. There's it's all different. So yeah, just like this question, like purchase a property.
Right. Well, for sure, Christine, because in today's world, I think that everything was running very smoothly in the commercial real estate market space. And then all of a sudden, when COVID hit, it actually ended up taking the various asset classes and segmented into least desirable, most desirable. And today, the favorite asset classes, I guess the most people are familiar with, would be multifamily and also the industrial marketplace. Both of those segments are very, very hot. The office market has become more challenging for a variety of reasons. The good news for the office market is that most of the owner are institutional landlords, so they're not going to be panicking. There's not as many private office landowners these days, so they won't be panicking. But having said that, we're just at the point now where we're starting to see people go back into offices in downtown Toronto. So we know that there's been a lot of office space that's been put onto the marketplace by many companies. So what we're waiting to see is, what is that new hybrid working model going to look like? And what is that? And that will determine what the real estate footprint is going to look like in some of these downtown office buildings, and who's going to benefit from that. Maybe the office buildings in 905 will. So, but it's not clear at this point in time. And retail, from a retail perspective, we've all seen it in our neighborhoods in terms of respect to if you walk major streets like Bloor or Queen West or Bloor West, you still see vacant stores. So that's changed dramatically as well. So in any event, so that's why, getting back to your original point, Christine, is that every real piece of commercial real estate has to be looked at in its own merit. So it's not generic, if you will.
Exactly. Yeah. So I always tell the borrower, the client, and say the commercial property is always case by case. Depends on the property, depends on the location, especially depends on the use, depends on the borrower too. Right.
Right. And actually, there was an office building deal that came through this office. I was talking to one of my colleagues earlier today, and the property was 95% leased, but there are a couple of major tenants. But you also have to look at the rent roll and look at the leases in terms of the remaining term. And at the end of the day, the conclusion came that it actually looked like it could be, you really had to underwrite it as it was vacant, because these companies were in the end of their 5-year terms.
Yeah, I saw people raising hands. I think we will not let people to speak because so many people online. If you have any questions, please just type in the chat box. Right. So let's go over. There's quite a few other questions. The other question from Lily, is there any investment amount limit? I guess Lily is the same question, probably talking about the ready capital. Ready capital, there's we right now have 45 million. For each investor, we capped maximum 5 million. But the smaller amount is 25,000 to start with. But if you give more than 5 million, I can turn you away. If that question is for the borrowing limit, I guess for firm capital, I can answer it for you, Michael. I think there's no upper limit for your borrowing higher limit, right?
Well, as I said, we do transactions $1 to $50 million, but I'd say our sweet spot's probably in the $15-20 million range. But we have the ability to do bigger transactions as well.
Yeah, for the smaller amount, also your lower limit is 1 million, is it?
Yes, it is. But we have, it is 1 million. But if there's a $500,000 transaction out there that's and it could be the beginning of a very good relationship with a good borrower, developer, investment property owner, we possibly can look at that as well.
Yeah, as a broker, I say like anything doesn't fit into our firm capital spot. Sure. Maybe I can find you a home as well. we do a mortgage, and also we do an unsecured loan as little as $5,000. So anything big and small, you can rent it over me too.
Right. If it makes sense, right, Christine?
If anything makes sense, we'll land on it.
For sure.
Okay, there's another question. Can I use a RED real estate mortgage loan with a floating interest rate? A residential mortgage, I guess, like a RED. I think it's typo. Can I use a residential mortgage loan with a floating interest rate, a variable rate? Michael?
Our rates are actually floating rates, to be frank. Yes, so it's the greater of if it's 7.25% or prime plus whatever that's equal to. So we do have floating rates. So and I think that our type of financing is that anybody that comes to us for residential mortgage is looking for bridge financing for a short period of time. And their ultimate goal is in that 6 or 12 month period of time, I may have to go back to an institutional lender. So the reason why you want floating rate money is because of the fact that you don't have to worry about prepayment penalties. You can accomplish whatever you need to do if you're cleaning up your credit bureau or you're waiting to get a promotion and have a new employment letter. Then those things are all factors that come into consideration in terms of getting a bridge financing loan on a short-term basis.
Great. There's another question: is what's the typical interest rate range? So, what's the typical interest rate range for multifamily property?
Well, I think that multifamily properties, most of the financing we do in multifamily properties are stabilization loans. So those would be in the 7 to 7.5% range. But if you're looking for multifamily property, multifamily money, if you're looking for, if you called up TD Bank and you're looking to get 75% loan to value in a conventional basis in a multifamily property, you're 3.5% possibly. Yeah. So that's for multifamily. Now, if it's a smaller transaction, you have to go to maybe a credit union or maybe a trust company. Then the numbers are going to be there's going to be a spread there higher.
Yeah, I was mentioned that in my last seminar. I think that's people are quite interested. We did multifamily properties with a CMHC insured. So with CMHC insured, the interest rate is lower than the residential 5-year rate. So that's the cheapest because that's considered one of the best assets. However, I just have to say, just not too many property there is like you purchase with a very good value in terms of a true value. So you usually you think you're paying pretty good market value, but end up to be much higher than the true value of the property because the commercial value is depending. Commercial properties valuation is depending on the income instead of the just market comparables. So it's not very easy, especially in GTA or in like the major urban area. You found a very good purchase, very good buy for multi-residentials usually.
Right, and if you're looking to go the CMHC route, you have to be very familiar with their underwriting guidelines as well, which are publicly available.
For the area you focus on, what is the cap rate you typically use, Michael?
For multifamily?
Yeah, I think so. That's from the same person who asked the question.
Yeah, well, typically, if you're buying something, it's usually I've seen institutional lenders buy multifamily properties with cap rates in the low 3s. For smaller properties, if you're talking about smaller properties, that could be anywhere from 4 to 5% cap rates on the buy side.
I think
depending on the property.
Depends on the property. That's very important. Yeah, commercial property is always case by case. Mm-hmm. Yeah, I think the next question is directed to me. It says, so if it's not guaranteed 8%, then everyone interest rate payment will be different. Then what's the payout base? Now we are very confident that Ready Capital, we will able to maintain more than 8% returns per year for the investor. So our monthly payment is actually fixed based on our projection of 8% returns. In the past 3 years, we achieved that and over that. We have the first year, I think it's around 8.11, 8.11, and then the second year, last year is 8.58 or something like that. And this year, after our audit financials complete, which is in next couple of weeks, I'm pretty sure that we have extra distributions. Since we're a mutual fund trust, so by the tax regulation, we have to pay out 100% our earning, our profit to all investors. So we are very confident that we can maintain the 8% interest rate payment to all investors. Okay. Then what about the interest rate Firm Capital generally offer in acquisition and construction loan for GTA industrial project? industrial projects and mixed use projects? That's two different for industrial projects, I guess.
Industrial projects. So we're probably in the 7 to 7.5% range. And so some might say that's high, but I think the other thing that you need to look at if you're building, so if it's, let's say it's a multi-tenant industrial building that you're building, it also comes back to the level of pre-leasing or the level of pre-sales of their condominium units. So I think that's one of, as a non-bank lender, we also have to be flexible in how we structure deals. So if you're going to a bank and you're looking for construction financing for industrial, they'll have a much higher threshold when it comes to pre-leasing or pre-sales if they're industrial condominium units, whereas someone like ourselves can be more flexible when it comes to structuring a deal like that.
There's another question, say mixed use properties, a 20 units apartment building and 7 stores. I guess that's the question is how much loan to value, what's the interest rate?
Sorry, a 20 unit apartment building and?
There's a 20 unit apartment store and apartments and 7 stores. I guess that's a mixed use properties. So I think the question is, what's the loan to value? What's the usually average interest rate?
So this is an existing building or something to be built?
The question is not that clear. I think they're probably purchasing a 20 unit apartment with 7 store mixed use. That's kind of apartment with a store front, I guess. Apartment building with a 7 store.
Right. So I think it
depends on the location. I think
not just location, but also in terms of what the rent roll says in terms of the commercial tenants. What percentage of the commercial income relates to the overall income, and but I would think that if you're looking to be conservative, then you're probably maybe in the 60-65% range, because the commercial retail that you have in the ground floor, I'm not sure if they're leased or not leased, but that can be an impediment in terms of getting more leverage as opposed to less.
Yeah. So if I want to say more about project like that, really, I think the most important thing is the location of the property. If we like the location of the property, if we like the property itself, say firm being more conservative. Actually, firm is very aggressive alternative lender, but sometimes if they lend 65%, if you can convince us to like the property as well, we may go up to 75%.
Right.
Firm. Yeah.
But also something we look at. We look at building condition report. What kind of condition is the property actually in, and then take a very hard look at the rents in terms of whether they're market rents or not market rents. And so it's just not an easy answer. I'm not trying to beat around the bush. That's just the reality. You need to do some hard analysis in terms of what the numbers are telling you.
Right. Next question. I do have a payoff commercial property. How do I refinance it for the investment? Most of banks are not doing it. Okay, Michael first, and I can add something later.
So what's your understanding of that question?
So the question is, the person say, I have a commercial property which already pay off. There's no mortgage on it. Oh. How do I take out the money for more investment? And he being rejected from the banks. So I would like you to start with. And
well, if you have a free and clear property, a commercial property, I'm not sure what type it is, but there's always, the way we look at it, there's always, I'm not sure why the banks are saying no. Obviously they have a reason, but there's always, when you look at it, typically there's always a loan amount that makes sense. So it also depends, I guess, what your expectations are. But if you're looking for a conservative loan amount, and the property is generating some cash flow, and then that can look after the debt service coverage that's required, then there's probably a way to find something to do.
Yeah, but I think I see those situations all the time. If the property is owner occupied, for instance, because the owner occupied, you don't pay yourself enough rent to make enough debt service. So they go to a bank, the bank will say no, because you don't have enough rent, you don't pay your lease enough. And then for the property owner itself as a business owner, they don't report enough income. So that's why when they go to the bank will say no, because everything you have to do the calculation of the coverage.
Right. So going back to, one of the fundamental principles we have on the alternative residential lending program is actually, what is the real estate worth, and what's the real equity in the property? So when it comes to commercial real estate, if we're talking about an industrial building here, then we would look at it and see, even if it was an owner occupied situation, if it's we would look at what is our exposure going to be dollars per square foot, and what are comparable properties trading at in that neighborhood.
Yeah, we are also want to say is because we know the Ontario property very well. So for us, like a Ready Capital, for instance, we are equity lenders. We don't really see the income, so we know the property's value, and we sometimes be more aggressive than most of the lenders, because we don't really need to see the income on the property. So sometimes that's the advantage we have, that to preserve the capital for our investors, but also we will be quite flexible for the borrowers to get financing through us.
Mm-hmm.
Okay, what's the cap rate you use to appraise a multifamily? Oh, that's already asked.
Yeah, I think we talked.
Yeah. What is the lowest interest rate in the history of your company that is paid to investors? I guess, Lily, I think that's probably to me again. Our interest rate minimum is over 8% already. Our lowest interest rate is 8.11 in the first year. But yeah. The other question, previous 12-month purchase, is commercial mix? Oh, that's what the same question, the same person was asking a question again. He said it's a purchase, a commercial mix, 7 stores, 20 apartment units. Rent roll is lower than market rent. How are you going to funding? Is based on net of income or LTV. Okay, so that the previous person who asked the question, we actually misunderstood him. He said he bought a property with 20 apartment. It's a 7-store building with 20 apartment units, but the rent roll is very low. How do you going to financing it?
From our perspective, we have to look at what the existing income is in the property, and lend based on what that net operating income is telling us, and what the appropriate cap rate is. So it can be maybe frustrating for someone to buy something and say, well, the market, it's well below market rents, the actual rents today. But that's the reason why you bought the property. You bought the property because you see there's upside. So the frustrating side on your side of the equation is maybe you have to put more equity in the property than you'd like, because you have these expected higher rates, but you don't have them today. You'll create them, and you will benefit at the point in time you're able to turn over the tenants and increase the rents. Then you can go to the marketplace and refinance. But at the beginning, it has to be underwritten based on the existing income that's in place.
Okay. Do you need the environmental report for multifamily building?
Yes.
Okay. Sometimes we don't really need environmental report with the multifamily building if we don't see the obvious threat of the environmental issue. We sometimes need an environmental survey to see what's the history. So there's one question. If I apply for a firm capital mortgage, do I have to apply through a broker?
So is that question directed towards you, Christine, or is it?
Yeah. So I think I should answer like for most of commercial application is more complex, and go through a broker will give you a big advantage than apply yourself. And especially we work together with commercial lenders like Firm Capital, and sometimes we can give you more money than you go direct, right, Michael? Do you provide some color on how you would underwrite properties with leases with 1 year remaining? How would you value the vacant space?
Well, I think what we would do is that we would see what the existing market rates are for the space today, and if it's going to be vacant, then we would attach a very conservative number in terms of when it does become vacant, and put that into our analysis.
Yeah. So,
but if that vacancy is going to cause the property to be 25% vacant, then that's a different issue. So depends on the materiality of the vacancy, but we would underwrite it based on a conservative number that's in place today.
Yeah, for some smaller commercials, we sometimes use a market rent even for the vacant space, and that's a advantage we have as a Ready Capital. Because we do recognize the value of the commercial property itself, and most commercial lenders out there, if it's vacant for a commercial property, there's no value because no income. But sometimes for the smaller commercial properties, we're being more aggressive in taking market rent.
Yeah, that makes sense.
So the question again, are you one of mix? So is it is probably is talking mortgage investment? Okay, that's really to us again. To me again, is a Ready Capital is one of the mix? No, we are mutual fund trust. MIC is mortgage investment corporations. It's different than us. We are mortgage investment trust. So we're more, I always say we're more regulated because every month we have to report our NAV value to Ontario Security Commission through our EMDs. And we have to give monthly report to our investors. We have more than, right now we have more than 400 investors now, but initially we had to have minimum 150 investors to qualify to be a mortgage investment trust. More questions? I think I reached the end of the questions. Is there any more questions on the YouTube? That's it. Any policies for foreign buyers, Michael?
Oh, any policies? We no, other than if you have good real estate with good equity, we look at the inherent equity involved in the real estate. So, yeah.
I'm actually very surprised today. There's nobody asked you of the commercial property. Construction loans. There's like I always getting so many questions in residential constructions and commercial constructions. Maybe you want to touch up a little bit. So when people like say residential construction, for instance, the people bought a very good location, a piece of land, and a rent down house. They want to tear down the house and build up a new residential luxury home. So how do you do the construction loan on that? If you do a construction loan on that?
Yes, so we can help out at the very initial stage in terms of the acquisition of that bungle that has no further economic life, and they're going to take it through the planning process. So we can help out on the land acquisition side, and typically we'll provide anywhere from 60 to 65%. It all depends on how expensive the lots are, but in that range. When it comes to hard construction financing for hard construction costs, we typically provide 100% of that number. We also provide an interest reserve. But as I mentioned earlier, so whatever the land advance facility is, the hard cost construction facility, and the interest reserve facility, that number can't exceed 80% loan to cost. So if it does, then the first number that gets cut back would be the land advance facility. So in this situation, really what that means is that if we're providing those three facilities, then whoever's buying the actual properties will be paying from their own resources, which is their equity in terms of paying for the architect, the planning process, and things of that nature. So as I said, we have two approaches. There's the first mortgage construction financing program, and then there's the second mortgage construction financing program, where someone buys a property and they happen to get bank financing or cheaper financing at the outset. So we can participate both ways.
Perfect. Yeah, the second financing option actually lots of times save people lots of money, because when you purchase that house, even though it's rundown house, you get the regular bank residential loan is much cheaper. And so foreign capital is able to do a second mortgage behind that, instead of asking you to pay off the first mortgage from the bank. I think that's very big advantage.
Right.
And also, Michael, maybe you want to touch up a little bit of your commercial construction. Like they're buying a big piece of land, they want to build a subdivision. Like when they acquire the land, you do the land construction, land financing, right? And then you roll that over as a construction loan later.
Yeah, we do the land financing. So I think it depends. So if there's significant pre-sales that are in place, then sometimes will end up happening is that the financing will end up going to possibly a credit union or a bank. If they're looking to do something with lower pre-sale financing, then that's something that we would entertain. So I think it comes back to our flexibility in terms of what the developer is trying to accomplish.
Yeah, I see, because your construction loan typically is much cheaper than your land loan, because you probably are getting the financing together with credit union. You're financing together with a credit union, right?
No. All the financings that we're doing for construction finance, we're in the 7 to 7.5% range typically.
Okay, yeah, that because they have lower pre-sale figures.
Correct.
Right.
Correct.
Okay. So I think there's a question also related to construction financing. What's the interest rate of construction loan? You already mentioned that. If the property is in Toronto, will get the lower rate? Will it get lower rate, I guess?
Yeah. So for us, it's if it's first mortgage construction loan, it's in the 7 to 7.5% range.
Okay. Does your company do the business in Alberta? I mean, Alberta, residential and commercial project. I think, yes, we already seen one example, right?
Yes. We just reopened our office in Alberta just within the last 2 weeks. So from an economic perspective, we think it's a good time to be re-entering the Alberta marketplace. And we're looking forward to it.
Yeah, I think you're pretty strong in BC as well, and also in Quebec too, right?
Primarily, we do business in the Montreal marketplace, but so it's the greater Montreal area. We're not in the smaller towns or smaller communities. We're really focused mostly on the island of Montreal, if you will.
Do you do in other provinces like Halifax? And for instance, actually, I do have a few Halifax inquiries recently.
Well, we're not active in that marketplace, but if it's residential related, then
Commercial.
it's actually commercial. So it would depend on what they're trying to accomplish in the commercial side. I'd have to understand what type of commercial it is first and foremost. So,
Right.
but we're not active. We don't have boots on the ground there, if you will. So, I think that one of the things that we try to do is we try to focus on markets that we really understand. So Southwestern Ontario, Toronto, we like Ottawa. But we also see what's happening, and we see what's happening in the GTA, though. We're getting from affordability perspective, we're getting pushed out to a lot of these smaller communities, because if you look at the activities taking places in like Niagara Falls, if you go north of Guelph or Kitchener-Waterloo, there's smaller markets where there's residential housing be created because there's a definite need for it. So, that's pushing us out. In Ontario, we don't mind going into some of those smaller market when it comes to residential side of the equation.
Great. There's another question. Do you offer loans for building laneway house? I guess the answer is yes. It depends on the size, right?
No, actually, we've financed a couple of transactions where there's laneway housing, and we're happy to look at them.
Very good. Okay. Well, looks like there's no more questions, and
okay.
I think that's great. I really enjoy learning all this from you, Michael, today. And
I learned a lot from you as well, Christine. So it was great for you to take us through your business model, and you're a very knowledgeable person. So thank you for the invite.
Thank you. Oh, there's one more question.
Always one more question.
So it says, I have a residential project, which is a big luxury house that already has loan on it. The land value is 850,000. The project cost is 2 million. Does your company can take it over, replace the existing loan? That's a good question.
So if you could just repeat the numbers in terms of what kind of value are we talking about here?
So the project cost, the construction cost will be 2 million.
Oh, okay.
The luxury home already have a mortgage on it. The land value is 850. So I guess you can pay off the small, because the land value is 850. The mortgage cannot be that big, right? So I think the cheapest way is getting a land loan and getting a construction financing on that 2 million too.
Mm-hmm.
So if a project costs 2 million, I heard you said a firm will sometimes go up to 100% of construction costs, right?
Right. No, our total financing can't exceed 80% of total project costs. So what are the total project costs here? If it's $850,000 for the land, is that what you said?
Right. The land value is 850 and the construction cost is 2 million.
And there's 2 million. So that's 2,850,000. And then they'll probably have some, interest and soft costs. I don't know, let's say $150,000. So you're talking about $3 million plus or minus?
Possibly the project costs 2 million. That's I guess the question that's the construction cost. And so with the land value of 850, so total
so total cost would probably be 3 million, Christine.
Yeah, with the
approximately plus or minus. So if they're looking to get a loan on that, then I would say that we don't want to be any higher than 80%, but let's just say 75% of costs. That's 2,250,000. So that would tell you that we could provide $2 million for hard costs, but on the land event side, it would only be $250,000. Understand? So if the land is the market value of the land is 850, then their equity has to go in somewhere, and it has to go in up front in the land.
Right. Yeah. This question is not complete because they didn't put in the other soft costs and the total cost on it. I have another incomplete question, which I don't know. It says now the lender only give 500,000, which is not enough to finish the project. What is, oh yeah, the same thing. So yeah, that's the same person who asked the question. The lender, I don't know who the lender is, only give
Right.
500,000. Yeah, you can talk to me, and I will do the numbers for you. Maybe we can get you a higher loan. I think 500,000. That's really not enough. Okay, the same person said the total cost is 3 million. So yeah, the person Brad, right? Brad, you can talk to me, and then we can go over those numbers again. So the
Right.
total project is 3 million. Yeah, you should get more than 500,000. Okay, I guess that's
Right.
it. We're
That's
10 to 9. That's pretty good timing.
pretty good time. Yeah, very, very good. We answer all the questions, right, guys?
Most of
Thank you
questions.
so.
Lots of questions actually. Thank you so much. Thank you, Christine, and thank you, Michael. Thank you for coming. And thank you guys who are staying here in the meeting room, and the viewers on YouTube. Thank you very much. Everybody have a good night. Thank you.
Thank you.
Yeah.
Bye-bye.
Thank you.
Good night.
Good night.
Good night.
Bye-bye.
Bye.